The I think at the end of the day, most people are complying with the information document requests. They are trying to gather up the information that the IRS has asked for. They are paying the tax because basically at the end of the day, they don't come up with any other choices that they find, I don't know if realistic is the best choice of words. They're not really coming up with any other strategies that they find to be any better, is probably a better way of saying it. One strategy that I know that some people have considered, although to the best of my knowledge it has not really taken off yet, is to have some type of litigation strategy within the United States, challenging the validity of the tax, just because it's one that doesn't really make a lot of sense. And I know that it's the kind of thing that a lot of people have talked about. I don't know that anybody has really moved forward with it. The tax tends to be, in most circumstances that I've run across, that the amounts are small enough in any particular period that the costs of fighting it are not justified. So everybody comes along and says, why would I'd spend more money fighting it, I may as well just pay it. And then the question is, as we'll see, that may be valid when you're talking about a deficiency that's asserted for one particular year in the past. But if this is going to be something that is going to become part of your, a perpetual tax liability as part of your ongoing operations, is that something that really people want to be paying every year, or is there some type of more appropriate strategy to get this in front of some impartial judge who may be more receptive to the argument that the tax is just wrong? So, in light of that, what is there to do? People are developing some strategies, and I'd love to be able to come up here and say that there's a magic bullet, there's something, here's the answer, but I would not. That's just not the case. There really is no, bullet solution to it. But I think what it's really coming down to is thinking about it in two ways. One is compliance, and one is transactional practices and structure. So in terms of compliance practices, what people are doing is they're starting to think about, okay, this is something that we're going to have to be thinking about from now on. If you get that information document request, if you get that notice of deficiency that says that you do owe tax for prior years, which is typically 2008, you may start thinking, okay, if they're charging us for 2008, they're probably going to be expecting payment for 2010 and 2011, et cetera, et cetera. Let's start thinking about implementing quarterly reporting as part of our ongoing tax compliance. Now, as part of that, what you have to do, because a lot of outbound premiums do benefit from treaty protection. So people are going through that dreary process of thinking about having the returns filed on time, thinking about having the payments made on time, thinking about going to their business partners, to their retrocessionaires, and saying, do you have a closing agreement? If you don't have a closing agreement, maybe there's a treaty exemption even in the absence of a closing agreement. Maybe we can find out some way, but really delving more fully into the compliance side of it and trying to figure out how to live with this on a long-term basis. Go to the next slide. And I think the other way of thinking about it is really transactional practices. How do you do your difference? How do you structure your business a little bit differently to reduce the amount of the bite of the federal excise tax, and think about this differently. So one thing that I'd like to talk about first is I know a number of companies that are really very much focusing on the number of times that any specific U.S. risk changes hands. And I guess basically what people are saying is, if I've got to pay FET once, that's survivable, it's kind of annoying, but it's not a huge amount of money, I can live with that. But what I don't want to get into a situation is where I have a company that's got 12 different carriers located all over the globe in all these different places, some of which have treaties, some of which don't, and all of a sudden I've got to do a lot of work tracking where the premiums end up, and also potentially pay FET multiple times. I think on the insured side, what people are really doing is trying to re-examine the structure of their insurance policies. And there, the type of client that I'm really referring to there would be an entity that would be, let's say you've got a U.S. company or a non-U.S. company that has a U.S. Operations or U.S. subsidiary, and there's a policy that's issued to the U.S. company, perhaps through a front, but perhaps not, that then gets reinsured maybe into Ireland or wherever, and then becomes part of a larger program. What they're saying is, okay, let us segregate that policy and make sure that we don't end up in a situation that sort of risks lying partly within the United States trap. Let's think about our insurance policies, how they work, how they fit into our overall program, just to make sure that we can put up some firewalls and limit the damage with respect to FET. And as you all know, taking one insurance policy and dividing it up into two is not nearly as simple as it sounds. You can't just take an insurance policy, one insurance policy, and say, okay, now we're going to have two insurance policies, one covering U.S. risks only, one worldwide, excluding U.S., because it does have an impact on deductibles, retention, aggregates, how all the different policy features relate to each other. So it's not a simple process, and it's not something that's done overnight, and it's not just rewriting one policy. But to the extent that companies do have large global policies that include U.S. risks, I think this is a process that people are going to have to start going through. And the other piece of the equation is really thinking about, once the risk moves from the insured to some other type of insurance carrier, some risk carrier, how many times, what happens then? Is there some type of pooling arrangement? What's the impact of a pooling arrangement? There are a number of clients that I've dealt with that have really duplicative captives that may have arisen during the course of corporate acquisitions or mergers or what have you, where you have risks, where you have several risks that are aggregated in one captive and then seeded and then retroceded, et cetera, et cetera. That's probably not such a great idea in today's environment. And I think that people are thinking about ways to streamline their internal risk transfer mechanisms. Okay. So really, just to summarize what I've got, the rule of the day right now is an increased IRS emphasis on the cascading FET. That's undeniable. I think we've all seen that, or certainly I have. Again, it's really a change of focus. There was no legal development. There was no new legislation. There was not even any new regulation. Regulations do have the force of law. There were no new regulations. It was just sort of the IRS re-examining a policy that they had always felt, an interpretation of the law that they had always viewed as correct. I'm sure budget pressures had something to do with it, I'm sure. But it's really a change of focus. It's not a change of no new legal developments. And I think really the question to the industry as a whole is, how do we deal with this? How do we respond to audits? How do we respond to examinations? Are we going to cooperate, or are we just going to take that envelope and throw it away and imagine we'd never received it? And then finally, I think the real, more deeper question is not just how do we respond to that audit that we got in the mail with respect to years 2008 or 2009. It's really, what are we going to do in the future? What do you guys need to be thinking about? What do companies need to be doing differently in order to minimize the impact of this position? That's it. Thank you.